Good afternoon, fellow traders. Welcome back again to another important video. Today I'll try my best to answer a few questions, but before that, I want to talk to you about what every trader or what you should know before you start trading with brokers, or things you should know about your broker before. So this is one of the reasons why, for me, personal live account, I have multiple brokers. I have IC Market, I have ETS Capital. I've been with ETS Capital since 2007. I've been with IC Market for also over 10 years. I have CMC Market for over 10 years, IG Index, and I have FXCM also over 10 years, IG Index more than 10 years. And the reason why is what I want to explain here. First, brokers want you to trade more, and the reason behind it is because the more you trade, the more you are likely to fail, and every broker wants you to fail, trust me, because they know 90% of traders lose money, and they want you to blow your account or have a margin call, blow your account and add more funds and start trading and lose again. That is why in this business the capital to start is very low, so it's minimum entry. So you can have you can open a live account and start with $50. Some brokers even allow you $20, $100, $200, and some will even entice you with matching 50% or 100% of whatever you put in, and they will offer you free education. Okay, some even will provide you with signals, and they want you to fail, because the more you start trading, because the broker is a businessman first and analyst second. So every business person is going into a business in order to win. Nobody starts a business and say, I'm starting a business in order to lose. And the more you trade, the more you're likely to make a mistake, the more you they make commission off you. That's why when you place a trade, your trade starts with negative, because that's the broker permission. So this is the more reason why some people like to use ECN or TSP. So they serve as like a middleman. So they take your orders and pass it on to an exchange, which is quite fair, no commission and things like that. So this is one reason. And two, brokers also take the other side of your trade. So when you are buying, they are selling. When you are selling, they are buying. Okay, so they know that eventually, because the brokers are spying on you whether you like it or not. That is why I'll talk about the next point so that you understand. The brokers are spying on you, and they know exactly how you think. So whenever you place a buy trade, they will also place a sell trade. Whenever you place a sell trade, they will also place a buy trade. And if the broker notices that one particular trader is very successful trading, then they copy your trade. So when you buy, you are buy, but 90% of them, they take other sides of your trade. Okay, it's only once you start trading and they see this trader is a profitable trader, then they start taking sides of your trade. So if you make 1,000 or 2,000 pounds, they are making 10 times more, because the broker has a lot of money, access to large capital than you. Believe me, the broker has a large, and your loss or your losses are the broker's win. And the next point I was saying is the broker also spies on you. So what do you mean by the broker? Because the broker spies on you, that is why they know, let's say, they know where your stop loss is. So everybody knows, the brokers know where you place your stop loss, and they know your stop losses, and they wait for the stop losses of large retail traders to be accumulated. Then they will take you out using the how do we call it, using your stop hunt, what we call the stop hunt. Okay, so it will take you out, assuming this, they know that traders, okay, here this is an uptrend. Okay, so they know a lot of people probably, let's say, are selling right here. Okay, this is a buy trade. Okay, so they know people are buying right here. Okay, sorry for the fair, and they know most people have put, a lot of people have put their stop loss right here. So they wait for the majority of the stop loss to be accumulated, and then they will take your stop hands. Okay, this is it. So assuming people have got a lot of buys here, okay, and their stop loss is here. Now they will use the stop hands to take you out, and the market, boom, they move it up. So that is why I have multiple brokers. You can see this is one live account that I used to do exposure. So I have my redrawn the money, and I am only left about 6 balance, and I'm going to put a new account into forward test. I don't put big money here, or my IC market has, because I use this to do forward testing of my strategies. So yes, so that's what they do. And if you are selling and assuming, you see here, they know people started selling, let's say, right from here, and stop loss is somewhere here. You see stop hands, they take you out, then they drop the market. So they watch your every move. Brokers actually watch your every move, so you have to be careful. That is why I compare even with my funded account. If I have the same trade in my live account, same stop loss, and I have the same stop loss on my funded account and other brokers, I'm looking at which will take me out and which will not take me out. Also, no broker has the same price. Okay, price of instruments varies from one broker to another broker. So for instance, if you see, this is the Nasdaq. If you click new order, you can see they have the sell at 1633.4 and the buy at 1633.8. This is slightly different quotes. If I go to IC market, if I go to FXCM, if I go to FTMO, and it's the same with the currencies as well. If you check your buy here, and yes, you can see the quotes here for your buy and your sell will be slightly different from your other broker account. One thing I wanted to draw your attention also is as people ask about the margin, the lot size rule. Okay, what you can do is, if you are trading a funded account, whichever company you are with, and you have a max lot rule, what you can do is, when you go to the tools, go to options, and here you can set, okay, the lot size, okay, set by default. So size by default, you can go here and use a default size. So if your lot size rule is, let's say, 10 per asset, you can set that here, 10 per asset, and you make it by default. Okay, if it is 20 by asset, you can go here and change it and put in 20 lot size, and you make it as your default, and you click OK, and it stays down. So anytime you click a new order, whichever instrument you are going to use, you have the default lot size. But to be safe, if you have a 10 lot size per asset. You can do 5 lot size by default. That does not mean that you cannot change the lot size here. That what it means is that anytime you press new order, the default size lot size is what is going to come, and you can still change it if you want to go a lot size bigger. You can still go, but it makes sure that it also always remind you. So if by mistake you what I did, but violated my funded account when I violated the lot size difference because I didn't have by default, and I have traded, and I have the last one I used was, let's say, 10. So when you click, you have 10 there, and by mistake I just click it because the platform wasn't working and I was just trying to do. So if that happens and your lot size is 10 lot size, you always have this by default. So even if by mistake you click 5, you have 5 lot size in, and by mistake you click another 5, that gives you the 10 lot size maximum you need per asset, which means that you are not going to violate the lot size. So if it is 10, I would recommend just do set it to 5 by default and leave it. If you set it to 5 by default and leave it, that will protect you. So let me see if I can get few 2 questions answered, and next time I can answer some of the questions that people message me. And so let me see. Okay, so we have I'm going through to find out what. So someone is asking how much money is traded on the forex market daily. Approximately it's 5 trillion worth of forex transactions which takes place, which is an average of 220 billion per hour. So that is it. Speculative makeup of roughly of 90% of the volume. Then someone also is asking how is the forex market regulated. Yes, there is a regulatory body to police it 24/7. So there are several in each country's set up. So yeah. So if you go to the Australia, for example, then it will be Australian ASIC, that is the Australian Securities and Investment Commission. And the, if you go to America, there is the SEC, and each country, yes. So this is it. And someone also is asking, someone is saying, what is a leverage in forex? So leverage is means of the exposure to large amount of currency without having to pay full volume of your trade upfront. So Mpacho, excuse me, give me a few minutes. You put down a small deposit known as margin. Okay, so when you close a leverage position, your profit or loss is based on the full size of your trade. So if you're using other instruments, leverage also can differ. For instance, those who trade contract CFDs products, or who trade advanced traders who use options and stuff like that, the leverage and margin also, which means that your broker can borrow you money that does not belongs to you. So for instance, if you put $1,000 or £1,000 in your account, you can trade up to like as if you have 10,000 in your account. So that's the 9,000 difference is what your broker is borrowing you, and if you lose it, the broker is going to call you and you have to pay for it. Okay. Okay, so someone also is asking, let me see. So what moves the market? Yes, well, I will just say a few things. I wouldn't go into details, okay? So we have so many things. We have the news, we have central banks activity, we have the market sentiment, we have economic data, credit ratings. You know, these are all activities that will combine and move a market, and we have the technicals as well, that is analyzing your charts. But this all comes together as a one force, and they help to decide to move the market, whether it's going to go up or it's going to go down. Okay, then we have someone was asking, we talk about the pairs. Yes, so we have a minor pairs, we have the major pairs, and we have the exotic pairs, then we have the regional pairs. Okay, so I'll give you example of the minor pairs are the Euro USD, USD JPY, Pound USD. These are the major pairs, sorry, not a minor. So the major pairs are the Aussie dollar USD, USD CAD, USD CHF, Pound USD, Euro USD, then USD JPY. And the minor pairs examples are the Euro CHF, Euro Pound, and Pound. Yes, so the minor pairs are less frequently traded, and the major pairs, which forms the seven currencies, make up 80% of the global trading. Then we have the exotic pairs. Okay, that is a major currency against one from small or emerging economy. Example is the USD and the Polish zloty, or the pound, Great British pound, and the sterling versus the Mexican peso. Then the regional pairs are classified by region, such as the Scandinavian or Australasia. It includes Euro NOK, that is Euro versus the Norwegian krona, then Aussie dollar versus the New Zealand dollar. So this is the end of the stream today, and I'll get back to you another time. Have a good trading week. Stay safe, and I'll catch you up later.